Did you know that the average annual return for the stock market is about 10%? But what if I told you that predicting stock prices might not be as impossible as it seems? Stick around because today, we're diving into some secrets that could change the way you think about investing. Welcome back, everyone. Today, we're going to talk about predicting stock prices. If you've ever wondered how some people seem to always be on the money with their trades while others are left scratching their heads, you're in the right place. Predicting stock prices is more relevant now than ever, especially in our fast-paced financial landscape. So, let's get started. Presentation of problem/challenge. Alright, let's get real for a second. One of the biggest challenges investors face is the uncertainty of the stock market. Prices can swing dramatically based on news, market sentiment, or even the weather. It's like trying to predict the weather. You can look at forecasts, but sometimes, it just doesn't go as planned. Many investors struggle with understanding what drives stock prices, leading them to make impulsive decisions. And let's be honest, that can cause some serious losses. So, how do we tackle this problem? Exploration/development. Now, there are a few methods and tools out there that can help us make sense of stock price predictions. One popular approach is technical analysis. This involves looking at historical price patterns and trading volume to forecast future movements. Then, we have fundamental analysis, where you dig into a company's financials, management, and competitive position. Checking out earnings reports and balance sheets. Lastly, don't forget about market sentiment. This means gauging how investors feel about the market or a particular stock, which can greatly influence its price. By combining these methods, you can create a more comprehensive strategy for predicting stock prices. Climax/key moment. Here's the juicy part. One key insight that can significantly enhance your stock prediction capabilities is the use of specific indicators, like moving averages or RSI, relative strength index. By looking at these indicators, you can identify trends and potential reversal points in the market. For instance, if you notice a stock's price crossing above its moving average, it might signal a good time to buy. Likewise, the RSI can show whether a stock is overbought or oversold, helping you make more informed decisions. So, keep an eye on these tools, they could give you that edge you need. Conclusion/summary. To wrap things up, we've covered some serious ground today. We discussed the challenges of predicting stock prices and explored different methods like technical and fundamental analysis, as well as market sentiment. Remember, informed decision-making is key in stock trading. The more you know, the better your chances of success. Call to action, CTA. Now, I want to hear from you. What are your thoughts on predicting stock prices? Have you tried any of these methods before? Let me know in the comments below. And if you're interested in learning more about stock trading strategies, check out the video linked here. Until next time, happy investing.